Okay, let's look now at the statement of retained earnings, last but not least. Remember, these statements all begin with the company name, then the name of the financial statement, statement of retained earnings. Well, I guess we're going to have the balance sheet after this, so it's not last but not least. And then for the month ended November 30th, 2014. Now it's just a matter of filling in our balance sheet. Our balance sheet, or no, I'm sorry, not balance sheet. I got balance sheet on the head. The statement of retained earnings begins with beginning retained earnings. So it's retained earnings October 31st, which is the old cycle date. And what we're doing is we're taking the retained earnings that we had back then. If you look at the first row here, retained earnings was $3,200. What makes retained earnings go up is net income. Net income is right here, which is nice and handy right above us. And that gives us a total of $11,400. $11,400 being the $3,200 plus the $8,200. Then what lowers retained earnings is when you declare dividends. You'll notice that we declared dividends of $2,900. So we're going to put $2,900. Notice we don't put minus $2,900. The reason we don't put minus $2,900 is because we have the less sitting out here. That instructs the financial statement reader that you're going to be subtracting that amount. And that gives us the end of the period's retained earnings. The end of the period's retained earnings is the $3,200 plus the $8,200 minus the $2,900 for a total of $8,500. And that's the statement of retained earnings. Let's go ahead and go on to, while we're here, let's go ahead and complete the balance sheet. Since I had it on the head, might as well finish it now. Remember, everything begins with the name of the company. And then we have the name of the financial statement. And remember, the balance sheet is the one that has just the date. It doesn't have for the period of. It's not analyzing a certain time period. It's a snapshot of what the company looks like at November 30th. So let's go ahead and start laying out our assets, liabilities, and stockholders' equity, which will be greatly facilitated by our analysis up here at the top, right? Well, we have cash at the end of the period, because that's November 30th. And if we look up here, we will notice that we have cash of $4,650. I'm zoning in here on the ending cash amount. So let's put $4,650. And then we have accounts receivable. Notice we're basically tracking left to right here. We're going left to right, $6,350. Then after accounts receivable, we have supplies. Come up here to the top. See our supplies account is $1,400. And last but not least is the equipment account. That's usually one of the bigger amounts because it tends to have obviously some capital goods that are very expensive to purchase. And the equipment account, if you look up here, started the period at $11,600 and it remains $11,600. And if you look, that is all of our assets that this company happens to have. Cash, AR, supplies, and equipment. So now we just need to calculate our total assets. Our total assets are $4,650 plus $6,350 plus $1,400 plus $11,600. Now we can add it up one by one. Another thing we can do is we can cheat. We can come up here and say, well, we know total assets are $24,000. So it's already been added up once for us. Okay, so liabilities, sliding over to liabilities, the only liability we have is accounts payable. If you slide up here, accounts payable, account ends for the period at $5,400. And that's the only liability we have, the $5,400. We don't have any other liability. When you look up here at the equation, That's the only liabilities we have. What we'll do next is go ahead and cheat. Common stock is 10,100 and retained earnings is 8,500. So what we'll do is we'll come out here and do 10,1 and 8,500. And remember we said common stock is what was the 10,100 and retained earnings was 8,500. Again, what I've done is just taken it straight off our accounting equation at the top. So that gives us a total stockholders' equity of 10,100 plus 8,500. That's 18,600. 18,600 plus 5,400 gives us 24,000. And that's our balance sheet. This is all the requirements it has for this. Notice that the foundation of it is doing a good job of analyzing the accounting equation at the top in terms of the patterns of, when does cash drop? Notice getting the cash entry is important. Is cash dropping? Is cash going up? Are you paying on account? Are you receiving, is it on payable? Are you receiving it from a customer? That's an asset. Are you paying it to a vendor? That's a liability. If you can master the accounting equation, know what impact it has on retained earnings, and know how to label it, basically you can come down here and create your income statement without very much trouble, your statement of retained earnings, and your balance sheet. I hope you found this helpful.